Welcome back to my channel. In this video, I wanted to cover General Electric. They announced their earnings today, and the stock is up 4.91%. The market is up quite a bit today. It's good to see some green after a really rough day yesterday. I'd like to take a look at General Electric and see if it's priced at a discount or at a premium. I compare the stock price versus the intrinsic value of a company's stock. And the intrinsic value calculated based on principally the cash flow that a company is going to produce in the future. So I'll go through that with General Electric, and I'll show you my forecast for free cash flow on General Electric and see if this is a stock that's discounted and potentially a really good buy, or if it's priced at a premium and would be a sell. Overall, General Electric is a really good company. It's been around for a long time. Thomas Edison was the founder of the company a long time ago. The company recently broke up into three pieces, and the piece that I'm looking at is the company that produces turbines. And the company is $199 billion market cap, revenues $39.6 billion. So investors are paying about 5 times revenue for the company. PE is a little high at 29. That is a little bit high. Analysts like the stock and they think it's a strong buy. It's discounted by 15%. Over the past year, it's done really well. Even year to date, it's doing well. It's a producer of turbines for airplanes, and these have stayed in good demand over the last couple of years. One thing that I'm worried about is the travel industry is really slowing up, and airlines have really sold off, as well as the hotel stocks and so forth. So that might be an item to be worried about long term, the demand for new airplanes and to recondition existing airplanes. Over the 5 year, this has also just been a winning stock. General Electric was troubled for a while. Before the breakup, they had a lot of problems and the stock was not doing well. When I look at their revenue, good consistent revenue over the last couple of years, it is high single digit revenue growth, which is good. They did have, and this is the General Electric ticker. It saw part of its business be divested and split up. So when you see the revenue drop in 2022, it's because it was being divided, and it was an organic revenue loss. In 23, they had good revenue growth, and then 24 had really good revenue growth. The company does have good cash flow, and they've been growing their cash flow nicely from 24 in the most current quarter. They did have its peak of cash flow in 2022. They did dip a little bit in 23. I'm still going to project that they're going to grow cash flows by 10%. I might be a little optimistic, but I'd like to go with that. Not a lot of margin in this particular business. Aerospace and defense tends to be that way, but it is very stable business. So that's the margins for GE. Looking at the balance sheets, it's in good shape. The balance sheet is in very good shape. They've got 13.4 billion in cash and then 19.5 billion in debt. So they have a really sound balance sheet with debt to EBITDA being less than 2. And my qualifier is it has to be less than 3. So that looks good. Now look at the forecast. 13 analysts cover the stock, and they collectively, on average, think it's discounted by 15%. So they're basing it on earnings per share, and earnings per share did come down a bit in the 2025 year. They're expected to come down a bit. Then they're going to grow after that in 26 and 27. The revenue is going to dip this year and then pick back up next year and then the year after. I'm not sure I'm buying into that forecast. I think revenue might be a little light in 2026 and 2027 from those numbers. So now I'm going to calculate what I think the General Electric stock is worth by looking at their cash flows and calculating an intrinsic value based on cash flows. Also look at earnings per share, looking at the intrinsic value based on earnings per share. Starting with cash flow, I'm going to take the trailing 12 months and grow it by 10% in the first 4 years of this forecast. And then in terminal value, I'm going to grow by 4%. The discount rate I'm going to use to discount all those future free cash flows is 8% to get to a current net present value of $126 billion of value. I'm going to add the cash on the balance sheet and take away debt on the balance sheet to get to an equity value of 120 billion. The stock is trading up today, and the market cap currently is 200 billion. So overall, there's about a 40% premium on General Electric stock if I look at the intrinsic value of the stock compared to its current stock price. So investors have to pay up for General Electric. On earnings per share, it's a similar story. It's not a fast growing company, so I'm going to take their current earnings per share, just multiply it times a PE of 18. Again, it's not a fast growing company. Grow those earnings per share by 10%. I get to a stock price that is 41% too high. So when I combine the two numbers, I get to a 40% premium on General Electric stock. So the General Electric stock's done really well over the last 5 years, and the stock price has really gotten up there so much that you have to buy the stock at a 40% premium, and that's not a good idea for me. My investing strategy is to buy stocks that are discounted. Find great companies like General Electric, but buy them at a discount. That said, this stock is a sell for me. I would not own it. I would sell it if it was in my portfolio. It's just too expensive. So that's my review of General Electric, and I'd love to get your comments on it. If you're interested in analysis like this and would like to get the tools that I'm using as well as be more involved with the community, become a member, a paid member. It's easy to do. Just look at the details of the video, or you can look at my homepage and get signed up. Thanks for watching, and good luck with your investments.